Hello everyone, and welcome back to The Economic Guy, where we bring you the latest insights into global events. Today, we're diving deep into the 2022-23 Pakistani economic crisis, exploring its impact on the country and the world. Let's jump right into it. The 2022-23 Pakistani economic crisis has been making headlines, causing significant challenges for the country. Rising food, gas, and oil prices have hit hard, and it's not just a local issue. The global fuel prices skyrocketed due to the Russian invasion of Ukraine, adding more pressure to Pakistan's economic struggles. But why is Pakistan in this situation? Well, it's a combination of factors: excessive external borrowings, poor governance, and low productivity per capita. This has led to a balance of payment crisis, making it difficult for Pakistan to earn enough foreign exchange to cover its imports. Within this economic tapestry unfolds a chronicle of mismanagement, echoing through persistently large current account deficits. The repercussions led Pakistan to navigate through a staggering 22 financing arrangements with the International Monetary Fund, IMF, the latest of which was inked in 2019. As we peel back the layers of this economic saga, a nuanced picture emerges, exposing key contributors to capital flight from Pakistan. Dismal governance scores characterized by political instability, a lack of control over violence and corruption, the stronghold of elites and widening income inequality form the intricate threads of this narrative. Astonishingly, an estimated 50% of all borrowing since 2001 has been discreetly funneled abroad by the country's elites. This revelation underscores the urgent need for improved governance and economic policies to steer Pakistan away from an impending debt crisis. As the economic journey unfolds, the year 2022 stands as a pivotal chapter marked by unprecedented challenges. By June of that year, inflation reached an all-time high, casting a looming shadow alongside escalating food prices. Pakistan, at this juncture, finds itself in the throes of its most significant economic crisis since gaining independence. The annual inflation rate soared to 29.2% in November 2023, following a 26.9% increase in the preceding month. This surge was primarily fueled by a sharp rise in housing and utilities costs, spiking to 33% from 20.5% in October. Food inflation also quickened to 28%, up from 26.8% in the previous month. Further amplifying the challenge, the core inflation rate, which excludes volatile items, stood at 18.6% in November, marginally higher than the 18.5% observed in October. This intricate economic landscape signals a pressing need for strategic interventions to navigate Pakistan away from the precipice of a potential debt crisis. The Central Bank of Pakistan isn't a sitting duck either. They increased the interest rate to a robust 22% on October 30th, 2023. This decision was influenced by the acknowledgement that headline inflation had risen in September 2023 as anticipated. However, projections indicated a decline in October, with a commitment to a sustained downward trajectory, particularly in the second half of the fiscal year. Even though they raised the interest rate, with a 29% inflation and 22% interest rate, the real saving rate stays negative. So, this measure might not be enough, since it's better to consume now than to save for tomorrow. Now let's delve into the primary reason behind Pakistan's current economic crisis: the persistent trade deficit that has transformed into a daunting debt trap. In 2022, Pakistan's trade balance recorded a deficit of $42.87 billion, marking a significant 37.78% increase from the preceding year, which itself saw a 27.55% rise from 2020 with a deficit of $31.11 billion. Now let's connect the dots. A trade deficit occurs when a country's imports surpass its exports. This imbalance, when sustained over years, can lead to severe economic consequences. In Pakistan's case, the trade deficit has become a critical factor contributing to the economic downturn. The repercussions are evident in the country's foreign reserves, which decreased to $12.6 billion in October 2023. This trade deficit, however, has transcended its economic impact, evolving into a debt trap. The government's debt-to-GDP ratio soared to 89% in 2022, with a staggering one-third of the budget allocated to loan repayment. But what exactly is a debt trap? It occurs when entities struggle to repay borrowed funds due to high interest rates, insufficient income, or unfavorable terms. This creates a vicious cycle of borrowing to meet obligations, leading to a spiral of increasing debt and financial instability. Escaping a debt trap necessitates careful financial management and, in some instances, external assistance. In Pakistan's case, the historical relations with influential nations like China and the United States may play a crucial role in shaping its path toward economic recovery. Just to give you some perspective, $10 billion were given by various countries to help Pakistan. Yet the interest rate remains high. Now let's explore the realm of gross domestic product, GDP. The per capita GDP in Pakistan stands at a mere 12% of the world's average, with the latest recorded figure at $1,535.72 in 2022. This stark contrast prompts an intriguing comparison with neighboring India. Historically, Pakistan boasted a higher GDP per capita than India, but the dynamics have shifted, leaving Pakistan currently with a significantly lower per capita GDP than its Indian counterpart. This transformation in the economic narrative highlights the evolving fortunes and challenges faced by both nations over the years. So, there you have it, a snapshot of the complex web of Pakistan's economic challenges. The road to recovery will undoubtedly be tough, but with strategic global partnerships and robust reforms, there's hope for a brighter future. If you found this video informative, give it a thumbs up, share it with your friends, and comment down below with your thoughts. Don't forget to subscribe for more in-depth analyses. Until next time, this is the Economic Guy signing off.